Hello everyone, Carl Capolingua here, Market Analyst at Think Markets Australia, with a short video aimed at helping you protect your portfolio in a bear market. Let's kick off with a question for you. Are you even supposed to be here? This video is strictly for investors who understand that markets don't always go up. And I do think many investors have been lulled into a false sense of security by the financial media and by financial services companies who have a vested interest in convincing you that markets go up in the long run and there's nothing to worry about. Now, my job today is not to scare the pants off you, but to illustrate that markets don't always go up. There's an old saying, of course, markets go up by the staircase and down by the elevator shaft. So we don't want to be this unfortunate person dangling with our feet in the air, hopefully holding on to something. We need some strategies to protect ourselves. And I've got a 4-step process to tell you exactly how to do it today. So keep watching. Let's kick off with just putting bull markets and bear markets into perspective. And hands down, bull markets are the most dominant path of movement for stocks. So bull markets being the markets where stocks are going up, bear markets being the markets where stocks are going down. And clearly the blue zones are much taller, so bigger gains, and much wider, so longer durations, than the bear markets, which are the yellow zones. On average, bull markets go for about 4.5 years, and we see gains of around about 150%. So quite spectacular. Bear markets, in comparison, tend to last for somewhere around about 10 or 11 months and see falls typically of around about 30%. Around about 20% of the time, the market is in a bear market. What's the message here? Well, look, they don't look huge by comparison, but we have seen bear markets where up to half of investors' wealth has been wiped out. And I'm talking the GFC, where we saw about 52% here wiped off, and there was one there in the early 70s where we saw about 48% off wiped off. Now, if you lose half of your capital, think about what you need to make to get back to where you started. You've got 50%, you need to double that or make 100% to get back to where you started. And think about how long it takes to make 100% in the market. It's almost the next bull market. So I think the key theme there is don't get hit. Find some strategies to protect yourself and hopefully minimize losses to a fraction of what everybody else tends to lose. And therefore, it's much easier and much quicker to make that back in the next bull market and get ahead over time. Let us look at the dot-com crash on the NASDAQ. And I could have used the GFC, I could have used 87, I could have used 29. Go check out the charts. They're uncannily similar each time we go through these cycles. But I've used this one because I think, in terms of the excitement and the euphoria that investors were feeling this time around, I think it was very similar last time around in my experience. Look at what happened, 78% decline in 31 months. Let us move forward to what's happening now. Okay, and actually, I will just quickly go backwards and forwards and backwards and forwards. And you can see just how similar these moves are, just even in terms of the little rallies and dips that led up to the top. And then after the top, look how similar this time's move is to last time as well. Okay, now I am not saying that therefore prices are guaranteed to fall, but there is an old saying, history doesn't necessarily repeat, but it sure can rhyme. So what is your strategy if we follow the path of the red line? Okay, step number 1 in protecting your portfolio in a bear market is have an exit plan. Let's kick off though with what not to do. The old-fashioned buy, hold, and hope technique. And I've got a case study here. It's Zipco, which is quite a well-known, famous even Australian buy now, pay later company, famous for the spectacular run-up it had in 2021, and then the equally spectacular collapse from then as tech stocks went out of vogue. And trying to illustrate this idea here of not getting the top on something and the frustration that we have when we don't get the top, and the emoji there saying, darn, I knew I should have sold at 14. So the stock's gone from, 1, maybe we got in, I don't know, 7, 8 or 10. Doesn't matter. but we didn't get the top. We didn't get that $14, whatever it was, and the stock's now at 10. And we're thinking, well, what should I do? Well, I deserve 14. Look, I'll hang on. It'll go back up again. And when it gets to 14, I'm sure I'll get out. That's the green arrow where that $10 mark was. We can see what happened after that. The stocks fell to around about 50 or 60 cents off the top of my head. It's now still trading beneath $1. The risk is we get into this mentality of I'll just hold until it goes back up to where I should have sold. This idea of not being able to take a loss, the fear of crystallizing a loss because we expect as soon as we take that loss, the price will go back up again and we'll regret it. I put to you, the regret you feel in this scenario by holding all the way down is far greater than that other regret. So what are the key things we can do to prevent that from happening? In terms of having a plan on your exits, and I'll keep throwing these old sayings at you in this video today, but if you fail to plan, you are planning to fail. So part of this 4-step process is really giving you a clear plan on how to deal with bear markets. So in terms of getting out, preventing those big losses like we saw on Zip, we can use a stop loss. That's an obvious and very popular way of doing things. And stop losses can be automated with our broker, or they can be discretionary. So look, the stock gets to a price, we'll jump on our broking platform and make sure we get out. You can use an amount-based stop, and this is typically a dollar amount. So it might be, in Zip's case, let's say we got in at 8, we set a stop loss at 7. If the price moves to 10, we might then move our stop loss by a specific amount, or you can use a percentage-based amount. I think that probably works better, especially when you consider a stock like Zip, where $1 at the start of its move is very large compared to $1 at the end of its move. Let us have a quick look. There are a couple of others we'll talk about as we go through the slides, so technical analysis-based and index-based portfolio management. The first one is the amount-based, and I've just used a very simple dollar-based example here, and it just illustrates with the red line how your stop can be initially set and then trailed up at each sort of a trigger price movement. So it's Worley Parsons. We get in there at 10. We set our stop loss at 9. The stock gets to 11. Hey, don't leave your stop loss at 9. We trail it up to 10. Whether we do it on a discretionary basis or we get onto a platform and change that in the system. Stock goes to 12, we go to 11 with our stop, and so on and so forth. Eventually, the price comes back to our trailed stop at 14, and we're stopped out. Now, is it possible that Worley goes straight back up to $20 and makes you feel really foolish for getting out at 14? Well, first thing, I don't think you'd be too upset because that was a really nice trade for you. The second thing is there's nothing stopping you from getting back onto Worley Parsons as it goes through 15 or 15.50 through the old high there. So, we have to dispense with this notion that you get one crack at a trade on every stock, and that's it. You can always get back in if your stop loss is hit, right? If the stock continues to go up. Now, this is the second bullet point we had, which was the technical analysis-based stop. And I've used the 50 and 200 period moving averages here because they are super, super popular. And, I can only cover so much in this video. You can go off and Google this, and there'll be plenty of information out there on how to use this one. But the way I like to use these is to say, well, the exit signal is going to occur in various sequences. Okay, it's just maths. The maths of this will kind of ensure these things will happen in this sort of order, where the 50 period moving average will turn down first. We might use that as a catalyst to reduce some of our position. So the other thing is you don't have to be all in and all out. If you've got this all in and all out mentality, it does kind of force you to feel you have to be perfect with your entry and perfect with your exit. If you take this stepped entry and stepped exit strategy that I like to use, then if you get in and the stock falls away, that's not so bad. You didn't put your whole position in. If it goes up, you put more in, that's fine as well. But if you get out of some and the stock keeps going up, you don't feel so bad either. So let's say that the 50 period moving average, that's the red line, turns down. That might be your catalyst to exit 1/3. Then the second exit signal there is the close beneath the blue line, the 200 period moving average. And then the final exit signal might be the famous death cross, where the red line 50 period moving average closes beneath the 200 period moving average blue line. The death cross there doesn't sound good. So look, in this case on Zip, you would have had, you would have been exiting positions anywhere. It's quite a wide range between sort of $6 and $10, but certainly far better than not having a plan, buy, hold, and hope strategy and just getting wiped out completely. So that's the message. At least we've got a plan. Now, this third aspect of having an exit plan is using an index-based portfolio management. Sounds complicated, not that complicated. We use an index, an appropriate index for your portfolio. Now, I've just gone the NASDAQ composite because we started with it. Let's continue on that theme. And I like to use my moving average ribbons. Many of you listening today know what my ribbons are. If you don't, I've got a link coming up in this video. Stay tuned to the end where you can attend a webinar with me and I talk about them all the time. Okay, so I'll give you the exact parameters of the moving average ribbons and I teach you how to use them. Today, I'm just showing you the basics. It's a traffic light system and you can use your own set of indicators to work something like this out. But the message is, on the way up, my traffic light system says green is go, happy days. You can have, a substantial amount of risk in the market. The corollary of that, of course, is you have very little cash. And let's just say, hypothetically speaking, you might be running at 10% cash levels. Traffic light system, so as the indicators start to turn down, we get into that orange zone, you don't keep buying. So some of your stocks are going to be getting stopped out, no doubt, based upon what the index is doing, but we don't replace those with other stocks. We're happy to build up our cash levels here. We might even start to entertain some short trades, and I'll talk about that in a second. And then we get to the red zone. So that is really stop investing in new companies. Look, there's always stuff that goes up in a bear market, to be fair, so you might still have a little nibble on a few of those, but predominantly we are going to cash. I think that's the key message there, and waiting for the market to improve again before we put our money in. So none of this tells you where to put a stop loss on any individual stock in your portfolio, but it does holistically govern how you manage your portfolio during various phases of the market. Okay, number 2 in our 4-step plan of protecting your portfolio in a bear market is to trade short. Okay, you've probably heard about it. A lot of people get confused by this. I'm going to make it really simple for you. Okay, a short trade is just simply a trade which profits when the price of an asset falls. Now, typically it involves borrowing the asset, selling it into the market, and then buying it back at a later date, hopefully at a later price. Now, this is a schematic that I've created for my bear market survival guide, right? It's an ebook. It's got about 36 pages in it. It talks about all this stuff in incredible detail. Again, I'll provide the link in the YouTube post below. It's free to download. Make sure you get that. I'm going to keep it simple here. We're going to take the simple path, but I did want to put this in just to illustrate the complexity of traditional short selling. And it is generally restricted to your large and institutional investors who have access to stock lending pools, the ability to go to big investors and borrow the stock off them so they can then sell that into the market. Traditional short selling is complex. The way I suggest you do it is to investigate these financial instruments called contracts for difference, or CFDs. All a CFD does is replicates a transaction in an underlying asset. Let's say a stock, for example, but we don't need to borrow the asset. Okay, we just go through the process of the transaction. Now, CFDs have gotten a little bit of a bad rap from time to time in the past, but generally because some investors have lost money using them. And the potential problem here is that you can lose more than your deposit on a CFD trade. So let's say you put a deposit down of $500 to do a trade. If you don't manage your risk correctly with discipline, with stop losses, you could lose more than that $500. Now, Think Markets, we have a system called negative balance protection to protect our clients from that ever happening, but it might not be the case with your other CFD brokers. Look, the message I have for you here is this tradesman using that circular saw. He's got all the protective equipment on. He's had all the training in using that circular saw. And what that circular saw does for him is it does the job faster, it does the job quicker and cleaner than if he was using the old-fashioned handsaw. Now, should that circular saw, should there be a mishap, lapse in concentration, and he knocks a couple of fingers off, I don't think you can blame the circular saw. Okay, it's not the circular saw's fault. It is always the person using the tool's fault. CFDs are just a tool, ladies and gentlemen. Don't blame the CFD. If something goes wrong, I think you need to blame the person using it. How can we use CFDs to trade short in the market? Well, just very quickly, the old-fashioned buy, hold, and hope approach would have us going onto our stockbroking platform, finding the stock we want to buy, entering the amount of stock we wish to buy, and then hitting the buy button. At some stage, hopefully the price goes up. That's what we want. We hit the sell button and we make a tidy profit. Fantastic. The opposite scenario, we know that all too well. In a bear market, potentially, the price doesn't go up, it goes down and we sell at a loss. Okay, let's flip everything on its head and do the short selling now. If you're using a CFD, for example, with Think Markets, you head into your Think Trader account, you find the stock you're looking to short. Hey, it might be Tesla if you're trading US shares, it might be BHP if you're trading Aussie shares. Once again, you enter the amount of stock you wish to trade in. This time though, you hit the sell button. And we don't have to worry about any of those complicated stock borrowing, stock lending arrangements. Your CFD broker understands that this is just going to replicate a short trade, and you'll settle the difference of that trade somewhere down the track. And the other thing which is self-evident for the broker is that you are hitting the sell button first. You don't already own this stock. So by the very fact that you're hitting the sell button first, it tells the broker that you are initiating a short trade. Now, somewhere down the track, the opposite needs to occur, and the opposite of selling is buying. Also opposite is our payoff dynamics. So this time we want the price to go down. If it goes down, we're going to make a profit. But if it does happen to go up, we're going to make a loss. And we need all of those exit plans that we talked about before in terms of stops and trailing stops to protect us if that occurs. Let's continue to use Zip as a case study here. And hypothetically speaking, we're using my traffic light system. And around about this time here, you can see it goes to the red zone there. And we decide to short sell. The price of the market is about $5, just keeping numbers nice and even. We can see here that to place our stop loss, that now needs to go above our entry price. Remembering that in a short trade, if the price goes up, that's when we're losing the money. Our take profit order needs to go beneath our entry price. And let's just use round numbers here and say we set a take profit at $1. Let's see how the maths works out. Once again, selling first at $5, the price went up to our stop loss at $6, we would lose. If the price goes down to our target there at 1, we would buy. To close out the trade, we would hit the buy button. In terms of the PL, I want you to think of it in these terms. Imagine when you sell, you're getting a credit for the value of the trade. Okay, and in this case, let's assume we're doing a single share for $5, so we get a $5 credit. At some stage, it will cost us amount X to buy back those shares. Clearly, the cheaper we can buy back those shares, the more of our initial credit we'll have left at the end, which will be our profit. Now, in this case, it didn't go our way. The price went up to $6. We hit the buy button and we've got a debit at the end of this trade of $6. So at the start, we had a credit of $5. At the end, we had a debit of $6, which leaves us with a $1 loss. In this case, everything goes our way. Zip falls to $1. Think about how devastated all of the other shareholders in Zip are. You're not devastated at all. You are cheering it all the way down. But your initial $5 credit is subtracted by your $1 debit at the end, now leaving you a $4 profit. Let's get on to our second step of protecting your portfolio in a bear market, and that is to hedge your portfolio, potentially again with CFDs. And what we're going to do here is take a short trade on the stocks in our portfolio. A lot of people come to me and say, hey, Carl, look, I do think the market's going down. I get it, but I don't want to sell my shares. I can see the portfolio management tool's gone all red, but I don't want to sell my shares. Capital gains tax is a problem, or I would feel naked without my shares. I get it. Okay, what can we do in that scenario? Well, this concept of hedging simply means having a bet each way. So your main bet is your portfolio. You want that to go up. What we're going to do here is take an equal and opposite position on our portfolio, and each stock in our portfolio using CFD. So for example, if we had the 50 Tesla shares, we would be looking to short 50 Tesla CFDs. If we had 1,000 BHP shares, we'd be looking to short 1,000 BHP CFDs. And if you can create that equal and opposite position on your portfolio compared to the CFD shorts, you have effectively eliminated your downside risk. It really doesn't matter how much your portfolio goes down now. You're your stock-based portfolio, the profits on the shorts in your CFDs will compensate you for those losses. Now, this is really exciting because if you can use, again, the traffic light system to tell you when to close out those shorts, the profit you take on those shorts can be reinvested back into the stocks in your portfolio or to add new stocks in your portfolio. And you think about when the profits on the shorts come. They come when prices have fallen a long way. So the cash you have here to reinvest is generally done at some pretty good prices in the market. Now think about how that compares to your average buy, hold and hope strategy, where people are just holding their portfolios all the way down and then waiting for them to go up again. You're really being proactive here. Now, the asterisk is important. The asterisk says, yes, you've eliminated your downside risk, but at the same time, there's no free lunches. You've eliminated your upside risk as well. So if your portfolio increases in value, it's not a bear market anymore, it turns into a bull market, you won't get any profits on that portfolio until you close out your hedge. But again, we need to have a strategy for understanding when and how to do that. But think of it in these terms. You are potentially giving up some reward, and let's say it's 5% or 10% until we back out of those hedges to get complete downside protection. So maybe you're giving up 5 or 10% to get 100% protection. I think from a risk return perspective, I think that's a really, really sensible and valid way of looking at things. Okay, fourth and final point on how to protect your portfolio in a bear market is to diversify across asset classes. And you can use indices. So typically, if your portfolio is going down, it's because indices are going down. Think about shorting those indices to make a profit there or to hedge out your portfolio. Foreign exchange, I'm going to show you in a second, one currency which historically has an extremely high correlation, almost 1-for-1, of going down when stock markets are going down, and then commodities, because this time around, there were a couple of commodities that actually caused the bear market. So maybe we don't go short those. Maybe we can look to go long those commodities to protect our portfolio. Okay, typical protection strategy for your portfolio is to short the index. Okay, if your stocks are going down, the stocks in your portfolio are going down, the index is probably going down. We can take a short trade on the index to hedge out our risk. Number two, the Australian dollar versus the US dollar. The Aussie dollar is very much a global growth oriented currency. It tends to do well when global growth is going well, and it tends to therefore do poorly when the global economy is contracting. And that's what's happening now. We're expecting a potentially sharp recession in a number of major economies around the world, and we can see how, as the stock markets have transitioned to the downside, the Aussie dollar has also transitioned to the downside. This time around, the big problem is inflation, okay? And one of the major contributors to inflation is energy prices, particularly after the invasion of Ukraine by Russia, and that occurred around here. And we can see just how much the price of crude oil, that's on screen, how much that went up over that time. And because it contributed to inflation, central banks decided to increase interest rates, and it's the increasing of interest rates very rapidly that has hurt the stock market. So here, your protection strategy is actually to go long, to find those commodities that are heading up and to be long those to protect yourself against their negative impact on your portfolio. So potentially at times, we can see as the global economy worsened, crude oil has started to go down, and maybe you can flip that as well now to potentially, if the global economy gets worse, by shorting crude oil, which you would expect to go down, that can also protect your portfolio as well. So you need to be a little bit proactive and flexible with your thinking on that. I promised earlier that I would give you the link for my Ask the Experts webinar, where you can catch up with me on a weekly basis. Come and hang out with me at 1 p.m. Tuesdays, Australian Eastern Daylight Saving Time. And I will take a look at the stocks in your portfolio, provide you all this same sort of analysis, and give you great detail on my traffic light system. Free to join. Okay, just hit that link there, www.thinkmarkets.com/au webinars to register. All major markets and all investors are welcome. I'll give you a fundamental and technical reader on those, and plenty of learn to trade as well. And before you go, I just wanted to let you know about Think Market's amazing offering. If you're trading Australian shares, we've got over 3,100 of them, including ETFs, $8 flat rate per trade, and CHESS sponsored as well. Very important that you are the beneficial owner of your shares, and that can only occur through CHESS sponsorship. So make sure your broker offers you that. We've talked a lot about trading foreign exchange, indices, commodities. You can trade all of those things, including crypto and shares as well with CFDs. And that allows you, of course, to go long and short and do it all commission free. And commission free on shares is definitely going to save you a bunch of money in the long run. We are an award-winning broker. We have offices all over the world, and we are regulated in each of those jurisdictions. Over here in Australia, we're regulated by the Australian Securities and Investment Commission, or ASIC, and we have our own financial services license. It's an easy-to-use multi-asset platform. You can be trading in your stock portfolio over here, long-term stock portfolio, and at the same time trading CFDs on all of those other instruments as well. World-class trading apps on web and mobile as well. Dedicated account manager. You get to speak to a real person who gets to know you and will look after you through your entire trading journey. For more information, head to www.thinkmarkets.com/au for details. If you're watching me on YouTube, please hit the subscribe button to stay notified of any future videos I put up. I'm regularly streaming during the week. And please hit the like button to let me know you like what I'm doing so I'll continue to do more of it. Well, it's been a pleasure chatting with you today. Hopefully you learned lots, especially how to protect your portfolio in a bear market. All the best until we catch up again. Bye-bye for now.